Hey there, it's Leslie Stokes. I'm a writer and geologist with the Northern Miner, and I'm here with Mining Clips today in downtown Vancouver for the Sprott conference. And I have Eric Coffin with me. And nice to see you, Eric.
Yeah, nice seeing you, Leslie.
This is my first time meeting you, so it's such a pleasure.
Thank you.
So I just wanted to talk to you about the U.S. economy. I know we've seen a lot of interest rate hikes come over the past 6-8 months or so, and what do you foresee in the future is going to happen?
If you look at what's something I've talked about a lot in the last little while is there's two, in a very broad sense, there's two types of economic measures you get. Economic readings, ones that the street follows. You get hard readings, which is like, something like, what's the trade deficit, what were auto sales last month, employment reports, sort of things like that. And then you have a lot of soft measures, survey measures, ISM numbers, all of those sort of things are, and even the employment numbers to some extent because of the way they do it, are survey numbers. And after Trump was elected, we saw this huge Trump boost. And everybody was going gaga on like, oh, the economy is going to accelerate, blah, 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 blah. New York was flying.
Magic pill.
I couldn't convince myself of that, in part because there was, and there still is, this very big divergence between survey numbers, and that is opinions, if you will, are still relatively strong, but they're weakening now, and the hard numbers, things like actual retail sales, that sort of stuff, those were not accelerating. They still aren't. My feeling is the U.S. economy is going to keep muddling along at 1.5%, 2%, maybe nothing great. I'm not a gloom and doom type, but I think we do need to recognize that we're 8 years into an expansion, which is a really long time. And I'm a bit skeptical about the Fed raising rates too many more times. I mean, inflation bounced up to a little over 2%. The measure that they prefer is called the personal consumption expenditure deflator. That's the one that the Fed watches. It's gone all the way back to 1.4 in the last 2 or 3 months percent, way below the 2% they wanted to be at. Part of that's oil prices, but it's been a pretty broad decline. So when I look at the Fed's jawboning the last couple of months, what I'm hearing isn't we think inflation is going to accelerate because of the great job numbers and we want to get ahead of that by, we don't want to be late and get behind the curve on interest rates. That's what they say. That's not what I hear. What I hear is asset markets are scaring the crap out of us and we have to blow the froth off them because I don't want to be the next Greenspan or the next Bernanke. Thank you very much. I don't want this one attached to me. That's what I'm hearing. Maybe I'm just more cynical than everyone else, and I don't actually even blame the Fed. I mean, there are asset markets that just got to crap on me too, so I don't blame them. I don't think it'll work like it never has before. The only thing that really works is them actually raising rates. If the inflation doesn't pick up again in the next little while, it's going to be very hard for them to justify rate increases. I think we may see them do the balance sheet reduction that they've been talking about for a year. They might start that in September. I'd be surprised to see another rate increase before December. And I'm not even sure we'll see that one if we don't see inflation pick up. Because right now, where inflation actually is, they really can't justify it. I mean, there is not an inflation problem.
And so in terms of the markets,
yes,
then what kind of impact can we see on the markets? And right now, where are we seeing the money flowing to?
The vast majority of money lately, I mean, we're starting to see things tilt a little bit, and I hope it continues. Most money that's gone into the market, particularly lately from the retail side, it's gone into two basic types of instruments, ETFs and passive investment vehicles, where they're just matching the index. And when you get almost all of your money flows that are coming to the market coming through those routes, you get this weird paradigm where, it's sort of like what the left is talking about in the States, where the rich get richer and the poor get poorer. If you're an index fund, you're basically buying the percentage of your fund is trying to match the index. So every time a company like the really big guys like Amazon, Alphabet, Netflix, all those ones that are already very successful and overweighted, you have to buy that weighting because you're just trying to match the index. You're not trying to think about it. You're trying to match the index. So as they get bigger, more and more your money flows to those ones. So you're getting this stretch valuations on this small number of companies. What concerns me and concerns a number of other people is these are not decisions being made by a set of erudite fund managers where he's looking at Alphabet or she's looking at Netflix and going, okay, this is what I think the growth rate's going to be, this is what their earnings are, blah, 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 blah. This is a bunch of algorithms. They're set up to match the index, or they're set up to create a certain risk level, basically to match a volatility level. There was thinking involved in writing the algorithm, but there's no thinking involved in the trading. It's all automated. Something like 40 or 50% of the money that goes through the Wall Street every day now is algorithmic money.
Oh, wow.
It's computers trading with computers. What makes me nervous, and it makes a lot of other people nervous too, is it's all very one-sided money. There's a lot of herding effect when everybody's running the same kind of algorithms. What scares me is that when things roll over, and I don't know how far they have to go because I didn't write the algorithm, I don't know where the trigger points are, but when things roll over, my expectation is you have exactly the same herding effect in the other direction. Roll all this ETF money and passive money. If those guys head for the exit at the same time, I don't know who the buyer is going to be. So although I don't see conditions in the economy that make me worry about a crash, and I'm not, to be clear, I don't think there's a high probability, but the one thing that makes me worry about crashes going forward is this current setup where I just fear that when the markets do roll over, there's no buyer there. Like all of this money is in all of these funds, and they're all going to be on the same side of the trade, which unfortunately would be the sell side at that point. And I don't know who the buyer is, like that, because that's just not where the money is. The money's all with those guys that would be selling under those circumstances.
So
it's a crazy market. It's nuts.
So what should investors do then to protect themselves, say, if those sorts of circumstances come?
I don't think it's a bad idea if you've got all your money in passive funds. It's not a bad idea to talk to your broker about, say, find out what it would cost you to buy out of the money index puts, say, which aren't, as long as you go far enough out of the money, they're not that expensive. I mean, you have to roll them over every few months. It's not cost-free, but that is something you can do where it's just kind of a built-in, if the market crashes, your index stuff is going to get crapped on, but the put is going to be, basically a put, you're betting on something going down. So if you own index puts, then if the market drops and most of your portfolio is going down the toilet, those index puts are going in the opposite direction.
Okay.
I do think there's some safety, assuming it's not like a big crash, it was just a correction. I do think there's some safety to be had in commodities and in precious metal stocks, because I think part of the reason you haven't seen gold miners, for instance, behave that well in the last year or so is they tend to be a little bit more of a risk-on investment, or risk-off investment, if you will. And right now, everything's 100% risk-on. It's just everybody's all in. Everybody's throwing every cent at the market. And in those conditions, nobody wants any insurance. Nobody's worried about a market decline. So you tend not to get as much money flowing into miners. So I think if we had a correction, you'd probably see the gold miners trade a lot better.
Okay.
So I think there's some protection there. But if you're really worried about it, well, one, you just sell some stuff. That's not a bad idea to have some cash. But something like index puts, which any good broker can explain to you how they work.
Great. Well, thank you so much, Eric, for joining us today.
Thanks for
Nice talking to
having
you.
me.
Okay.
Okay.